Well, it's a lovely day in Melbourne today for the third day of the Australian Tennis Open, but I'm here today to talk about the Westpac-Melbourne Institute Index of Consumer Sentiment. That was released today and it showed that consumer sentiment had fallen by 2% from 104.3 to 102.2. So we still have a majority of optimists over pessimists, given that the index is above that 100 level. That's a remarkably resilient result. And if we compare that with previous responses in the index to major COVID-related events, so an 18% fall when COVID first emerged back in March last year, a 6% fall when we had the lockdown in Melbourne back in 2020, and then a 5% fall with the New South Wales lockdown with the emergence of Delta last year. So it's been a remarkably resilient result, although having said that, we did see a 9.6% fall in how people see the outlook for the economy in the next 12 months, and a 6.1% fall in how they see the economy over the next 5 years. There was also an interesting contrast between results in Sydney, in New South Wales and Victoria relative to the results in Queensland, Western Australia and South Australia. New South Wales and Victoria, the index was up slightly, whereas in those other states it was down quite sharply. And I think what that represents is that those larger states have been conditioned now to dealing with COVID issues, whereas the other states have not really been as conditioned. And so the shock to have widespread COVID, obviously with the exception of Western Australia, but with the expectation it may well eventually occur, has obviously impacted more on those smaller states. When we look at the overall profile of the index over the course of the survey week, going from the 10th of January to the 14th of January, we did see a deterioration over the course of that week, indicating that as we went further into the week, there was more concern about the Omicron developments. Offsetting those large falls in the economic outlook was a 7.5% rise in how people feel about their finances since 12 months ago. And that, of course, reflects the fact that they've been saving significantly over that period, savings rate averaging about 17% over that 2-year period. They've accumulated, we think, around about 250 billion in excess balances. They've also been buoyed by rising house prices, and of course what we're seeing now, which is a sharp lift in wages growth and employment growth, also supporting the feeling about incomes. Having said that, we did see over the course of the week a deterioration in the level of the index as we went through from that week beginning the 10th of January to the 14th of January. We also saw a 2.1% fall in how respondents feel about the outlook for their finances over the next 12 months. Now, obviously their view about the economic environment is one factor, but the other factor is what they're thinking about interest rates. So we're asking a question about the outlook for interest rates every month now, given how important this interest rate profile is going to be for the economy over the next few years. 55% of the respondents said they thought interest rates were going to go up. That compares with 31% a year ago. And interestingly, 55% thought they'd go up in the course of the next 12 months. And that indeed is suggesting that the Reserve Bank's assurances that they're not going to raise rates until late 23, early 24 are being treated a little sceptically by the respondents. And of course, this concern about interest rates is feeding into how they're feeling about the housing market. So the index of house price expectations fell by 4.5%. It's now at its lowest level since November 2020. And indeed, for those people who are investors in investor property, that index is down by 15%. So it would appear that the outlook for the economy and the outlook for interest rates is starting to weigh on confidence around the outlook for house prices. Offsetting that is that we saw a 6.5% lift in the question, is now a good time to buy a dwelling. It's still down 35% from the November 2020 peaks. But that's more indicating people's feeling a little more comfortable about affordability. I think that those affordability numbers will be assisted by any fall we see in house prices, but they will be offset by rising interest rates. So I would expect that time to buy won't be recovering significantly at any time soon. So what does this all mean about the spending story for the Australian economy? We saw a report a few weeks ago that turnover in credit cards was down 26% in the first few weeks of January. But 15 to 20% of that 26% is actually seasonal. And in our own reports, we're seeing around a 6 to 7% fall in that turnover over that period. So the expectation is that certainly January will be a negative month for spending. But as we move forward, we're expecting to see a recovery in February and March and a stronger pickup in the June quarter than we'd seen before. So overall, there will be a negative impact on GDP over the course of 2022. But I think that people are actually overstating that impact. And that, of course, has been supported by this resilient result that we've seen on consumer sentiment. Thank you very much.